Welcome to Mrs. Moneybags Live. This episode is brought to you by quickequity.ca, getting you to your money fast by providing mortgage solutions to Canadians all across Canada. I am your host, Nicole Williams, aka Mrs. Moneybags, mortgage agent level 2. We go live Monday to Friday, keeping you posted on the latest financial developments, market trends, and economic news, helping our viewers make informed decisions about their money. Reminder to do your own research. This show is intended for information purposes only. Let's get into it. I hope you've had an amazing evening, and I'm happy and thankful that you are joining us once again for Mrs. Moneybags Live. Let's get into today's headlines. So here is your summary of mortgage, housing, and economic news from across Canada for Tuesday, January the 23rd, 2024. Let's get right into it. So the first article, believe it or not, that I want to discuss is WWE's Raw is moving to Netflix next year in a major streaming deal. WWE's Raw is moving to Netflix next year in a major streaming deal. How exciting is that? So WWE's weekly television show Raw will move to Netflix next year as part of a major streaming deal. Raw, which debuted in 1993, has produced 1,600 episodes to date and features wrestlers such as Cody Rhodes, Becky Lynch, Seth Rollins, and Rhea Ripley. The 3-hour program currently airs on USA Network, and its media rights were considered a hot commodity over the past several months, particularly after WWE returned of CM Punk in November, with many speculating it could land at any number of networks or streaming platforms. We are excited to have WWE Raw with its huge and passionate multi-generational fan base on Netflix, the chief content officer said in a prepared statement. WWE, which is part of TKO Group Holdings, said Tuesday that Raw will air on Netflix starting in January 2025. This will impact viewers in the US, Canada, the UK, Latin America, and other territories. WWE said that it will also impact additional countries and regions over time. This deal is transformational, TKO president and COO said in a prepared statement. It marries the can't-miss WWE product with Netflix's extraordinarily global reach and locks in significant and predictable economics for many years. Our partnership fundamentally alters and strengthens the media landscape, dramatically expands the reach of WWE, and brings weekly live appointment viewings to Netflix. WWE also said that its documentaries, original series, and forthcoming projects will be available on Netflix internationally starting in 2025. The move of Raw to Netflix follows the announcement in September by the World Wrestling Entertainment Inc. that Friday Night SmackDown would be moving from Fox to USA Network in 2024 under a new 5-year domestic media rights partnership with NBC Universal. As part of the agreement, WWE will also produce 4 primetime specials per year that will air on NBC. As part of the agreement, WWE will also produce 4 primetime specials per year that will air on NBC, starting in the 2024-2025 season. This will be the first time that WWE will air on the network in prime time. WWE also announced Tuesday that it reached a deal with Dwayne "The Rock" Johnson that will give the star the right to his nickname. Johnson will also join the board of TKO Group. Shares of TKO Group jumped more than 21% before the markets open. Very, very exciting. So a few things that this article touched upon. So my son is a huge wrestling fan. huge wrestling fan. And by default, I too have started to follow wrestling. Hence why I've included this article in today's news. And this is news. A, because wrestling is a staple entertainment uh, a show, event, series. It goes multi-generational. It is something that produces a lot of content. Therefore, advertisers and businesses love them. So the fact that they are now moving from cable TV to streaming also signifies the importance of the streaming platforms, which we have known for the past couple of years, or close to a decade. But this also helps to signify the importance of streaming platforms moving forward when we think about the big relationships with big producers of content, such as WWE. It also talked on Dwayne "The Rock" Johnson acquiring ownership of his name. As you know, Dwayne gained most notoriety from his presence on WWE, and the fact that he's now reached a deal to acquire The Rock, that name, it allows for so many opportunities for him from a business, from a marketing, from brand awareness, etc. So many opportunities. And the great thing is that it's showing that there's opportunity for other streaming platforms to do something similar. So, very interesting, not necessarily the typical mortgage news that we cover, but it is economic news. And because TKO Group, which is the group that owns WWE, does trade publicly, there's an opportunity for any investor that is looking for any uptick of being able to participate in the potential growth that this company may generate over the next coming years. What are your thoughts on WWE moving to Netflix? What are your thoughts about the new partnership with Dwayne "The Rock" Johnson? Drop your comments below. Let's get discussing them. And I know this is a little different than our typical mortgage news, but it is economic news nonetheless. Let us know your thoughts below in the comments. So the second article that I wanted to touch on today is the Bank of Canada's rate decision will reflect inflation's difficult last mile. Okay, so the Bank of Canada's rate decision will reflect inflation's difficult last mile. So as the Bank of Canada prepares to make its first interest rate decision of the year on Wednesday, economists say headwinds in the last mile of the inflation flight will serve as a final hurdle before rate cuts can begin. Inflation has cooled significantly from the highs of 8.1% in the summer of 2022, thanks in part to the Bank of Canada's rapid run-up in its benchmark interest rate. But while the first year of the central bank's rate tightening cycle saw inflation drop more than 5% points, the rate of annual price hikes has remained largely steady in the range of 3 to 4% over the past half year. Inflation ticked up to 3.4% in December 2023, according to Statistics Canada, as gas prices fell by less than they did in the same month a year earlier. While the mild acceleration was expected by forecasters, BMO chief economist Doug Porter flagged a stubbornness in core inflation holding around the mid 3% market as unsettling news for the Bank of Canada's efforts to restore annual price pressures to the 2% target. The last mile or kilometer of the inflation fight may prove to be the most challenging, he wrote in a note to clients last week. Low-hanging fruit on inflation already picked. James Orlando, director and economist at TD Bank, tells Global News that inflation eased more quickly in the beginning of the tightening cycle because of the reasons price pressure shot up in the first place: supply chain bottlenecks. The current inflationary period was primarily fueled at first by global supply chains failing to meet a surge of demand in the pandemic recovery, intensified by Russia's invasion of Ukraine, driving up prices on oil and food. Orlando explains that these pressures unwound and inflation dropped with it. The low-hanging fruit on getting inflation back down has been picked, Orlando says. But easing supply chains could only take the inflation flight so far, as they primarily influence goods and service prices. What's driving inflation higher today, Orlando says, are demands for services as well as for shelter amid surging rent and mortgage cost. But taming shelter inflation, which ran close to 6% in December, doesn't have a straightforward fix like remedying supply chains. The pressure in the rental market, for instance, is tied to years and years of underbuilding in Canada, Orlando said. Solutions for a housing deficit take years to resolve, with the rental market unlikely to rebalance even amid efforts at multiple levels of governments to quickly add supply, he explains. You can't just bring more housing supply rapidly onto the market to fix that balance like you could with, say, a semiconductor chip. That's why people say that the last mile on inflation is going to be a lot harder to bring down because that's just a slow-moving train that we're dealing with. So the Bank of Canada is expected to do a rate hold. The Bank of Canada is widely expected to hold its benchmark interest rate on Wednesday. Orlando explains that the decision for the Bank of Canada now is to gauge not whether it has sufficiently tightened monetary policy, but rather when it needs to shift to kickstarting the economy rather than cooling it. To make that judgment, he says, the central bank will have to pay close attention to the Canadian consumer. Consumer spending in Canada has been largely flat over the past year, Orlando explains, but those trends are expected to weaken even further with more households due for mortgage renewals in 2024. TD Mortgage and credit card data since 2021 show that households with mortgage renewals in 2023 were forced to rein in their expenses to accommodate higher monthly payments. But those with terms expiring in 2024 largely haven't made changes to their spending yet. Orlando says that with these several renewals on the books, the Bank of Canada can be fairly confident that consumer spending and by extension, the economy and inflation are set to slow even further in the year ahead. All the factors are in place that should lead consumer spending in Canada to still remain weak in 2024, he says. And if I'm the Bank of Canada, I'm thinking, okay, that means we've probably done enough on interest rates. RBC economists Nathan Janzen and Claire Fan said in a note to clients last week that inflation and still high wage growth has been too sticky to allow the Bank of Canada to pursue early interest rate cuts. They said they expect the Bank of Canada to push back against the idea that a shift to rate cuts is coming soon. Porter said in a note that persistent wage pressures and signs in late 2023 that the housing market was stirring would have the central bank doggedly maintain a cautious stance about the path of rates in its communications this week. Risk for the rate cut timeline. Both RBC and BMO expect interest rate cuts to begin sometime in mid-2024. But TD Bank is among those forecasters expecting easing to begin in the spring. That's not a foregone conclusion, Orlando notes, particularly given risk in the same global supply chains that underpinned the initial run-up in inflation. Fresh geopolitical tensions like these risk turning the tailwinds from unwinding supply chain kinks into headwinds, Orlando says, which, if they materialize into significant price pressures, would mean all bets are off for where inflation lands in 2024. However, he also notes that the risk to the downside for inflation, if the Canadian economy slows more sharply, likely outweigh the upside risk of another supply chain shock for the Bank of Canada at this juncture. In the Canadian economy, if the Canadian economy happens to accelerate, for example, with a strong spring housing market and the job market remains resilient, Orlando says, that will push back the Bank of Canada's schedule for rate cuts. Conversely, if there's a sharper slowdown, expect that timeline to move up. Orlando says that while the labor market showed plenty of signs of cooling in 2024, that slowdown might start to bring about net job losses in the months ahead. Like mortgage renewals, a rising trend of layoffs would have lots of influence over Canadian consumers if they see their incomes take a significant hit. As the Canadian consumer goes, so goes the economy, Orlando says. So very, very interesting. We hear from three of the major lenders, BMO, RBC, and TD, on their forecast as to what the Bank of Canada will do tomorrow with the interest rate. So the overwhelming response is that the interest will be unchanged tomorrow. So their thought is that we will continue to see interest rates hold. TD is expecting rates to come down as early as spring, while BMO and RBC are looking for interest rates to come down to the mid part or later on in 2024. What are your thoughts on this? Do you have any questions? Drop your comments below. Let's get talking. Let us know what your thoughts are and how you think and what you think the Bank of Canada, and what are your predictions for the Bank of Canada's rate decision tomorrow. Let's get into the third article. So, Black Friday bust. Canadian retail sales fell in November. So, kind of similar to what we were hearing about, Canadians, reining in on their spending. The headline doesn't surprise me. Does it surprise you? Drop your thoughts in the comments below, but let's get into the article. Black Friday bust. Canadian retail sales fell in November. Canada's holiday sales period got underway in November with a 0.2% decline in retail sales, led by falling purchases at food and beverage retailers. The data released by Statistics Canada on Friday revealed November's retail sales amounted to $66.6 billion, lower than many economists had expected. Shelley, an economist with BMO Capital Markets, declared the month a Black Friday bust. The headline drop in retail sales was disappointing, she wrote in a note to clients. Weak sales volumes point to an economy that remained at a standstill in November as consumers continue to adjust to a higher interest rate environment. Core retail sales, which exclude gas stations, fuel vendors, and motor vehicle and part dealers, were down 0.6% in the month. The decrease was driven by declines in 4 of the 9 subsectors Statistics Canada tracks. There was a 1.4% drop at food and beverage retailers and a 1.8% fall in general merchandise. Sales at supermarkets and other grocery retailers, excluding convenience stores, were down 1.6%, and beer, wine, and liquor retails experienced a 3.3% fall. The decrease in grocery store sales wasn't a prices story, but could possibly reflect consumers substituting towards lower price brands at stores, as grocery store prices are generally still rising uncomfortably fast, said Catherine Judge of CIBC Capital Markets in a note. The largest increase to core retail sales in November came from clothing. Apparel, accessories, shoes, jewelry, luggage, and leather good retailers, which rose 1.5%. The largest increase in overall retail sales in November was seen across motor vehicle and parts dealers, which were up for a third consecutive month. Judge took the data to mean that Canadian consumers are increasingly struggling with higher interest rates. Rates remain high throughout 2023 as the Bank of Canada carried out hikes to attempt to get inflation to its 2% target, but the high rates were weighted on some purchasing decisions. Although with categories like grocery and general merchandise, Judge pointed out that sales were down in online shopping, a key measure of discretionary spending. On a seasonally adjusted basis, retail e-commerce sales were down 1.5% to $3.9 billion in November, accounting for 5.8% of total retail trade, compared with 5.9% in October, Statistics Canada said. Ahead of the holiday spending, Deloitte predicted the average Canadian shopper would spend $1,347 on purchases across the festive season, down 11% from last year. Roughly half of the more than 1,000 Canadians the consultancy company surveyed plan to buy only what their family needs this past holiday season. 71% said they would seek items on sale, and 29% would seek less expensive retailers to shop at. The country will get a better look at how accurate such data was next month, when Statistics Canada releases December's retail sales figures. The agency's early estimates for the month suggest sales increased 0.8%, but it warned the figure would be revised. Despite the advance estimate showing a rise in sales, Judge said we expect the strength to be fleeting given the weakening labor market and the impact of high interest rates on spending. Does anything that we shared in this article surprise you? For me, I don't believe it surprises me. What does surprise me is that groceries were down, because I feel even though people perhaps are getting less items, the amount of money that people are spending because of inflation seems to have bridged that gap. But what the article did touch on, which is very interesting, is that obviously people are buying groceries, people have to eat, but people are now choosing to go to lower brands or looking for brands that perhaps are not the name brands. Like if you're looking at buying a package of crackers, going to the high-end retailer versus going to the low-end retailer and saving 50% on that purchase, by the time you've added up, if you buy groceries, your cereal, your sugar, like whatever it is, pasta, but now you're choosing that lower brand to save versus what you would have paid for that higher end brand, or that marketed brand. That is where people are looking and choosing to save their money. What are your thoughts? Drop your comments below. Let's get talking. Does this surprise you? And does the actual title, Black Friday Bust, make sense to you? Makes sense to me, because it was a bust if they didn't even hit the targeted goals, but it wasn't really a bust overall. Black Friday Bust. That's a very poignant title. What are your thoughts? Drop your comments below. Okay, so that's what we have for the headline news today. Let's get into the financial tip of the day. So we are talking about maximizing your retirement savings. When is the last time you sat down with an advisor to go over your retirement goals, whatever your retirement goals are? That can mean you might want to retire when you're 50. You might want to retire when you're 40. You might want to retire when you're 60, 70, whatever it is. Have you sat down with an advisor recently to review your retirement goals, and have you implemented a strategy of how you are going to retire with success? Today's financial tip is to meet with an advisor to discuss your retirement plan and to get something on paper implemented to help you achieve your retirement goals. That is today's financial tip of the day. So let's get into today's Mrs. Moneybags money affirmation. So I deserve to be financially abundant and prosperous. I deserve to be financially abundant and prosperous. Let's say that together 3 times. I deserve to be financially abundant and prosperous. I deserve to be financially abundant and prosperous. I deserve to be financially abundant and prosperous. That's all the time we have for today. Thank you for tuning in to Mrs. Moneybags Live. And like always, we'll see you here again tomorrow. Have an amazing day.